Energy Transfer, ticker ET, is currently trading at $12.63, and over the past month, the stock is down by 2.17%, and over the past 6 months, the stock is up by 3.78%. Now, if we have a look at the 5-year graph, we can see that over the past 5 years, the stock fell by more than 25%. Now, even though this stock has a very high dividend yield of 9.5%, there are certainly things you will want to know about it before adding it to your portfolio. Now, when we jump to the monthly full, we can see that compared to other energy transfer companies, ET does not have an issue with cutting its dividends by more than a half when matters escalate. This can also be seen through the graph below where the huge dividend cut can be seen. And even though the dividend yield did recover since the big cut, it is clear that ET isn't fully invested into becoming a dividend growth company, something that most long-term investors are looking for when purchasing a company. Now, when we jump to tip ranks, we can see that the company currently has a 33% upside, and the analysts project a price of $16.78 by the end of 2023, with 9 buy ratings, 0 hold ratings, and 0 sell ratings. Now, to figure out whether ET is a good buy at its current trading price, we will jump over to my fully automatic stock valuation spreadsheets, where we will have a look at the 9-pillar analysis and calculate the intrinsic value using the Graham's formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. And all these models will lead to our ultimate valuation at the end of the video. And if you find these spreadsheets interesting, you can access them at my Patreon at the link in the description. With that, if we return to the stock screen and plug in the ticker ET, all the metrics will show up automatically. And right away we can see that the dividend yield of ET is indeed very high, sitting at 9.82%, with a dividend payout of $1.23 per share per year. Now, the trailing payout ratio of ET is sitting at 85%, which is higher than I like to see, but we will discuss that later in the video. We can see that the institutional ownership of ET is sitting below 40%, again something that I don't very much like. The beta of ET is sitting at 1.73, quite a high beta, meaning that you will see more volatility with ET than you would see with the overall market. Now, if we jump to the 9-pillar analysis, right away we can see that most of the pillars here are indeed in the green, but that doesn't mean that ET is a good purchase. If we have a closer look, right away we can see that the long-term liabilities over the 5-year free cash flow negative dividends is sitting at 9.18, which means that with their current free cash flow and the current dividends they pay out, it would take them about 50 years to pay off all their long-term liabilities, which is a major red flag in this case. Now, disregarding this pillar, ET does have a consecutive growth rate of 3.32%, an increasing revenue growth and increasing free cash flow with a 5-year profit margin of 25.82%. Now, generally we like to see decrease in shares outstanding, but as ET is quite a new firm, the decrease in shares outstanding isn't that big of a deal. The price to free cash flow of ET is sitting at a very nice value of 10.63, as well as the 5-year PE ratio, which is showing to be 1.19, but if we scroll down to the financials, we can see that the actual PE ratio over the past 5 years is sitting at about 8, which is still a very decent PE ratio. But now we can jump to calculating the intrinsic value, first using the Graham's formula revised, which is mainly based on the earnings per share and the earnings per share growth estimate of a company. So to get the intrinsic value, we take the earnings per share, which you multiply by the average yield on AA corporation bonds, and the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier, which in this case would be 1. And this gives us an intrinsic value of $15.31, which is currently 17% higher than the current trading price. Now we can jump to our next valuation model, the discounted cash flow model. Here the cash flow over the past 10 years shows up automatically when we plug in the ticker into the program, calculating the average growth rate to be at 267.29%. And as we can see, the free cash flow has been pretty jumpy over the past few years, and therefore I project a growth rate of 6.5%, which calculates the future free cash flow over the next 10 years. But to move on with the valuation, we need to calculate the present value of that future free cash flow, and we do that using the discount rate, which is currently sitting at about 9%. When we calculate the present value of that future free cash flow, we sum it all up, we add any cash and cash equivalents, subtract total debt, and get an equity value of 72.5 thousand. We then divide it by the shares outstanding and get an intrinsic value of $23.43, quite higher than the current trading price, showing that ET does have a healthy free cash flow compared to their shares outstanding. Now we can move to our third valuation model, the multiples valuation model. Here I will be comparing ET to EPD and KMI. I took these companies' current stock prices and divided by their current earnings per share to get their price to earnings ratios. I then averaged out their price to earnings ratio and multiplied by the earnings per share of ET to get an intrinsic value of $16.74. Again, quite higher than the current trading price. Now we can jump to our final valuation model, the dividend discount model, where we value ET based on their dividends and their dividend growth rate. We take the dividend payout over the past 5 years and calculate the average growth rate to be at 3.64%. Now, as I have mentioned before, ET does have quite a high payout ratio and a very high long-term liabilities over the 5-year free cash flow negative dividends. Therefore, I think that they will not be increasing their dividends by as much as they have been in the past. Therefore, I project a future growth rate of 1.5%. And of course, ET does pay out their dividends quarterly, so we will plug in a yearly dividend frequency of 4. We then calculate the next year's dividend using the projected growth rate, and to calculate the intrinsic value, we take the next year's dividend, which we divide by the WACC negative the projected growth rate to get an intrinsic value of $15.62. Again, about $3 higher than the current trading price. Now we can jump to our ultimate valuation, where we average out the Graham's formula revised, multiples valuation, discounted cash flow valuation, and the dividend discount valuation to get an intrinsic value of $17.77, about 40% higher than the current trading price. Now if we plug in a margin of safety of 10%, we would get an acceptable buy price of $15.99. Now if we try to plug in a margin of safety of 20%, that would give us an acceptable buy price at $14.22. Now, even though based on our valuation models, the intrinsic value of ET is quite higher than its current trading price, I would not base my whole investment on that. And I do believe that sooner or later, ET will be forced to make another cut to their dividends unless their free cash flow increases. With that, if you enjoyed this video, make sure to leave a like and consider subscribing as it really helps the channel out.